What's up, YouTube? Today I want to talk about the similarities of Tesla and AMC, specifically in regard to the derivative chain and how I think those situations being the same enable both of them to perpetually gamma squeeze. So essentially, the situation, to break it down real quick, needs perma bears who will just hate the stock and perma bulls who just love it. So if you look at Tesla, for instance, what you'll see is it's full of fundamental traders who do not like Tesla, or people who just don't like the brand, but essentially those are the perma bears. Now, every time Tesla is, at a resistance or hitting a bearish trend line, they're shorting Tesla. They're trying to make money shorting it. They do not like it. And they always trade this way. And sometimes they make money and sometimes they don't. But on the other side of that same situation, or the other side of the coin, is the perma bulls. Now, millennials, they love Elon Musk or they love Tesla, a lot of them. So what you find is they always go long. Every time it hits a support, every dip, they buy that dip. No matter what, they're not selling, they're just buying shares. Now, this is a whale or a hedge fund's dream. Now, the reason I say this is because it allows them to trade very easily. They know that there's always going to be people shorting at resistances, and there's always going to be people going long at supports. So, in turn, what ends up happening is that the whales or the hedge funds will switch sides of the trade depending on whether Tesla's in an impulse wave, a motive wave, or whether it's in a correction. So the general trend of Tesla is obviously bullish, right? It went from 40 to 800, 900. Now, it might be in a corrective state and be bearish for a little bit of while, but overall it's bullish. So what's occurring is essentially stocks move in waves. One of the types, there's only two. One of them is a motive wave, which is an impulse wave, and one's a corrective wave, which is against the trend. Now, what we see in these loved and these hated stocks is the same thing. They always correct in these symmetrical triangles like this. And that's because there's so many bulls who love the stock and there's so many bears who hate it. Now, what this ends up doing is the market makers, because they made their money long here, as they did this is how it's going to affect the derivative chain. Actually, I'm going to skip that for a second. We're going to just go through with the stock, right? So the market makers make their money long, so now they're shorting with the bears. Now what this is doing is it's driving the stock price down, but it's essentially like a spring, a coil. So it's compressing the stock price, lowering the implied volatility, and putting it into a buyer's zone. So now buyers want to come out and buy the stock because it's very low. AMC used to be 77, now it's sitting at 35, right? So it's entering into this buyer's zone. And what you're going to see is it lines up to key fib ratios. So essentially what ends up happening is if you take a look at the last impulse wave, which is just going to be simple fib high to the low of the impulse start, so downtrend, right, we started here, that's going to give you a very good range of fibs to work with. Now you don't want to draw with extended hours on, so we're going to restart it. Boom. Boom. Okay. Now we're entering into these buyer's zones. So essentially it's hitting major support lines like this one. It's hitting trend lines. You can draw one from like a month chart, like a 12-month trend line, or a all-time trend line. You can draw. There's many different ways to pick up on supports, right? That's my point. There's many different reasons for bulls to start buying down here. Now, as the market makers crushed the stock price by trading with the perma bears, right? We were on the losing. We, the apes, were on the losing side of the trade. We're buying and holding, right? And in doing so, that's creating this spring. So now, as soon as the large entities switch to going long again, it's going to put massive pressure on the derivative chain and trigger into another gamma squeeze. That's why everyone's putting the next range at the max of these fib ratios. So essentially, it's up to like 170, and then 207. So we hit the 323% retrace on the last move. So it's what I'm saying when I say that it's loading it like a spring. So let me get into the why now. So why would a market maker, not a market maker, why would a hedge fund or a whale start shorting the stock? Well, that's because the implied volatility after it goes through a major impulse wave up is so high that it's extremely lucrative to short the stock. They can start selling options. Now, anyone who is following DD, there's lots of stuff talking about out of the money calls hurting. Well, the reality is, yeah, that's someone's collecting that money on that, but it's a necessary evil for the stock to eventually gamma squeeze. That's part of the perma bulls, right? They need to be both buying the stock and buying the option chain, which they do. So essentially, what we're going to see is as the stock hits these buyer zones, the hedge funds and the whales will switch from selling options, right, which is lucrative until the implied volatility gets crushed. Now, it's not so unrealistic, right? If you look at the weekly options chain, it was used to be trading for 10% of the cost of the underlying to buy a call expiring in a few days that was 20% out of the money. Anyone who trades options will tell you that's absurd because it is. But that's how the market makers in the hedge funds and the whales will make their money. So now they're shorting with the bears, and it's entering into this buyer's zone, which is where we're going to start seeing massive shifts in the flow. We're going to start seeing volume spikes. This is the bears closing their short positions. Not the perma bears, the momentum traders. They're closing their short positions and they're starting to switch long. So as this happens, the stock's going to be a little bit volatile in this range, but essentially the tides will have shifted. Now the market makers will need to delta hedge by buying stock because the tides are no longer bearish. Their hedge is going to be shifted so it's neutral, right, or bullish. So this will contribute to calls landing in the money because both the whales, the market makers, the apes, and the momentum traders will all be buying the stock here. So essentially, it'll trap all of the perma bears who will always short, right? Necessary evil. It'll trap them and it'll squeeze them up. Now, this is a gamma squeeze, and that's what Tesla did. So it'll squeeze these traders all the way up to the next levels. And that's why I am starting to go long on AMC in the option chain here, because what I'm reading is that there was too much froth on the put side, right? Too many people were making money on the puts. So naturally, the next money move, once the stock's implied volatility is crushed and it's been shorted into a buyer's zone, the next way a large entity will make money is by going long. So now instead of trading against the apes, they will be trading with the apes. And to put this into a larger context, perpetual gamma squeezes like this will enable the mother of all squeeze because as the stock goes perpetually higher, that $10 short position they took starts becoming more and more expensive. Now, the money they can make by capping a loss on the upside becomes less and less as the interest rate on that $10 short becomes more expensive. Sorry about the stutter there, but yeah, essentially, I think that over the course of the next few months, we'll see AMC progressively go to the next fib ratios and then enter the same thing. It'll do the same thing again. It'll enter a corrective pattern and then essentially short squeeze its way back up. Now, this is a gamma squeeze, which is a type of short squeeze, which in my take will lead to the mother of all squeezes. All right, that's what I got for you. I'll leave it 10 minutes. I'm not going to edit it. Hope you guys liked it.